Welcome to the deep dive. So, if you've been tracking the markets lately, you definitely know the feeling. Weeks of just grinding sideways action.
Right. Yeah, the chop.
Exactly, the chop. And volatility that, well, it tested everyone's patience. We saw those huge liquidation cascades.
Followed by surprising strength, holding key levels.
Right. Surprisingly stubborn resilience. It really makes you wonder, is this messy period the last shakeout before things really take off? Or are we seeing the cycle top forming right now?
It's the big question.
It is. So our mission today is to try and cut through some of that noise. We went deep into some contrasting sources, technical reports, takes from well-known analysts looking at history, structural analyses, trying to give you the full picture.
Yeah, we've got a pretty interesting stack here. There's a detailed market report from the Crypto.Report, which is very technical.
Okay.
Then we looked at summaries covering Benjamin Cowan, who's very focused on historical cycles.
Right, the historical view.
And finally, some really deep structural and psychological points from the 1000X podcast team.
Got it. 3 different angles.
Exactly. And we're going to try and structure this logically. We'll start with the most immediate technical catalyst, something that could genuinely spark a rally, maybe even tomorrow.
Okay, the short term.
Then we'll pivot to the, let's say, the historical warnings, the reasons to be cautious.
A counter argument.
Right. And finally, we'll look at these deeper underlying structural shifts that, maybe mean history isn't the best guide anymore.
Okay, sounds like a plan. So let's unpack the setup first. You mentioned resilience after that big liquidation cascade. The source material really highlighted that, didn't it?
It did. I mean, normally an event like that could send markets spiraling down.
For sure.
But Bitcoin held pretty impressively above $100 K. That suggests, real demand under the surface.
Deep demand, yeah. But the sources say the really interesting potential for a reversal, the thing that could dictate the next few months. It's not actually about the dollar price itself.
No, and this is where it gets fascinating. The most compelling short-term bullish signal, according to the Crypto.Report, comes from looking at Bitcoin versus gold.
Okay, BTC versus gold, why is that important now?
Well, since August, Bitcoin has actually underperformed gold significantly. It's down about 30% against gold.
Interesting. So losing ground to the traditional safe haven.
Exactly. It shows capital flow towards safety, risk off. But the key thing now is where that ratio is currently sitting on the chart.
All right, so what's the potential reversal signal here?
It's testing a really critical multi-year support level in that BTC gold ratio chart right now.
Okay. So a make or break moment for that ratio.
Pretty much. And if that support holds, if we see a bounce or reversal, it signals a potential massive rotation of capital back into risk assets, specifically Bitcoin.
And what kind of move are we talking about if that reversal triggers?
The analysis suggests it could set the stage for something like a 70 to 80% rally in Bitcoin itself.
70 to 80%.
Oh, from
current levels.
So that puts us,
Flexion.
that points towards the 180K region.
Wow. Okay, $180,000. That's a significant target. And that implies this current choppy price action is actually a launch pad.
That's the bullish interpretation, yes. Yeah. The Crypto.Report sees that kind of move towards 180K as the thing that could finally ignite the, quote, final leg of this cycle.
The mania phase.
The mania phase, where traditionally altcoins really start to fly. But, and this is important, it's not just technicals. The macro environment needs to cooperate.
Right. The real world events. What's coming up?
Well, we have CPI data tomorrow, big one, and then the FOMC statement next week.
Always market movers.
Absolutely. So the ideal scenario for this 180K target, you want to see soft inflation numbers, maybe lower than expected.
Okay.
And then you want the Fed to clearly signal, yes, rate cuts are coming soon. Those are the exact catalysts needed to potentially fuel that rotation back into risk.
Got it. So that's the specific, very bullish blueprint. Technical trigger meets macro catalyst.
Precisely.
Okay. But now we need to bring in the contrast. The historical perspective, especially from Benjamin Cowan's analysis. If that gold ratio reversal doesn't happen, or if the macro disappoints, what does history tell us?
Well, Cowan's whole thesis really revolves around the clock, specifically the 4-year cycle.
The classic halving cycle.
Yes. And historically, it's been remarkably consistent. He points out that every single Bitcoin cycle peak has occurred in Q4 of the year after the halving.
Which is, right now, Q4 2025 in this hypothetical scenario based on a 2024 halving.
Exactly. So according to that historical pattern, the clock is ticking. We should be seeing a parabolic blow-off top develop sometime in November or December.
And if we don't, if year-end comes and goes without that massive peak.
And Cowan's view is pretty stark. The cycle is likely over. The top might already be in or very close, and we'd be heading into the next bear market phase.
But hang on, isn't that pattern, that Q4 expectation, something everyone is watching now, especially institutions?
That's a great point.
If everyone expects it, doesn't that kind of, I don't know, potentially invalidate it? The market loves to do the unexpected, right?
That is the absolute core tension here, isn't it? History versus the changing market structure. But Cowan doesn't just rely on the calendar. He points to a couple of immediate technical warning signs, too.
Okay, what are those?
First, Bitcoin is currently trading below its bull market support band.
Right, the key moving averages.
Yeah, that collection of moving averages that historically Bitcoin needs to stay above to maintain a strong, aggressive uptrend. Being below it is a serious warning flag.
Not ideal for the bulls. And the second sign.
He warns specifically about the 50-week moving average. If that level breaks down decisively, he suggests it might be the confirmation that the macro top is actually already in place. Game over for the cycle, potentially.
Okay, so clear technical levels to watch there. And what does this caution, this potential topping signal, mean for the rest of the market, like altcoins?
Well, it ties into Bitcoin dominance. Cowan noted dominance has been climbing for 6 straight weeks.
Right, money flowing out of alts and back into Bitcoin.
Exactly. He expects that trend to continue, potentially pushing dominance well past 60%. It's a defensive rotation, capital consolidating into the safest crypto asset.
So, following in that logic, don't expect fireworks from altcoins anytime soon. They likely stay weak unless or until Bitcoin decisively breaks its all-time highs, if it even does.
That's the general takeaway from his more cautious view. It's a very BTC first whisk-off approach right now.
Okay.
Although he did add an interesting bit of nuance.
No.
He mentioned the looming death cross on the chart, where the short-term moving average crosses below the long-term one.
Yeah, usually seen as very bearish.
Right. But he points out that in previous cycles, sometimes that very signal is actually mark a local bottom, not the start of a crash.
Huh. So even the ultimate bear signal could be a contrarian buy opportunity. Crypto loves doing that.
It does. It keeps things interesting, that's for sure.
That contradiction is actually a perfect transition. So we have the specific $180 technical hope tied to gold and the historical Q4 deadline breathing down our necks. But what if we just ignore the calendar for a second? What are the structural arguments saying this cycle might be fundamentally different and far from over? Let's get into the 1000X podcast analysis.
Yeah, this perspective is really focused on why the old 4-year cycle might be breaking down.
Okay.
And their core argument revolves around who is buying and selling. They believe that while OGs, the early crypto investors, the veterans might be taking significant profits now.
Which makes sense. They have huge gains.
Absolutely. But the key is that their selling pressure is being absorbed, and it's being absorbed by new whales.
Ah, the institutions.
Exactly. Massive institutional players, TradFi firms getting involved, the ETF buyers, they're acting like a giant sponge, basically soaking up supply that in previous cycles probably would have caused a much sharper crash.
Right, which leads directly to that kind of counterintuitive idea they mentioned. Sideways bullish.
Precisely. The fact the market can digest all this selling, all this profit-taking and hedging without collapsing, that's actually incredibly bullish behavior.
It shows there's deep-pocketed demand establishing a floor.
A high floor, right around these current levels.
Yeah.
It suggests strong conviction from these new large entrants.
And how does this connect to, fundamental adoption?
They pointed to what they see as an overlooked narrative. Crypto quietly starting to replace traditional financial infrastructure, the TradFi rails, as they put it.
Okay, any examples?
Yeah, they highlighted Ripple's huge $1 billion acquisition of G Treasury.
Right, I remember that.
They see that as a major signal of an aggressive push into B2B stablecoin use cases, industrial settlement. Basically, crypto moving beyond speculation into real-world financial plumbing.
And the argument is that this deep industrial adoption isn't really priced in yet.
Not even close, according to them. It suggests a long-term structural strength that completely transcends these shorter retail-driven trading cycles we've seen in the past.
That makes sense. And they also had a really interesting point about retail psychology, didn't they? The PTSD point.
Oh, absolutely spot on. They noted that many people who were active in the 2017 or 2021 markets, they got burned badly in the crashes that followed.
Yeah, 2022 was rough. That feeling is definitely real for a lot of people.
For sure. And that trauma, that PTSD, leads them to sell much earlier this time around. As soon as things get choppy or go sideways, the fear kicks in and they exit.
Creating opportunities for others.
Exactly. It creates these perfect entry points for the more patient, long-term investors, and importantly, for these institutions that are now systematically accumulating.
So discipline and managing emotion become the real edge.
Absolutely. It's less about chasing FOMO now and more about strategic positioning, especially with that institutional floor potentially being built.
Okay, let's bring it back to altcoins then. We had Cowan warning about an exodus, rising BTC dominance, danger zone for alts. But the Crypto.Report source actually suggested the altcoin season narrative isn't dead yet. How do they square that with the cautionary signs?
Well, their view is interesting. They argue that the severity of the recent liquidation cascade, the big wipeout we saw, that actually created the necessary precondition for an alt run.
How so?
Because it completely flushed out leverage. Altcoin open interest, funding rates, all that speculative froth. It got reset to bottom levels, as they put it.
So the market is clean now, less risk of an immediate cascade down.
Exactly. There's plenty of room for expansion now without overheating instantly. So their bullish view on alts is conditional. If Bitcoin makes that move towards 180K, if we get that big BTC rally.
And the FOMO spills over.
Precisely.
Yeah.
That's when you could see the real explosive altcoin breakout phase finally ignite. It needs BTC to lead the way first.
And we are seeing some supportive headlines, right? Big money flowing into specific crypto projects and infrastructure.
Definitely. The sources highlight a few things. You've got Polymarket, the prediction market platform. They're reportedly seeking new funding at a valuation up to like $15 billion. That's huge.
Wow. Shows serious belief in that sector.
It shows appetite for these kinds of on-chain information markets.
Yeah.
And then there's Hyperliquid Strategies filing with the SEC to raise $1 billion.
$1 billion? For what?
Explicitly to expand DeFi activity. That's serious institutional money targeting DeFi infrastructure.
Okay. And maybe even more fundamentally, Coinbase.
Yeah, this one's wild. Coinbase launched something called Payments MCP. It allows major AI models like Claude, Gemini, to actually send and receive crypto directly on-chain.
Wait, AI agents moving crypto?
Machine-to-machine crypto payments is the very beginning, but it's potentially transformative. Real financial infrastructure, not just speculation.
That's a big step. And even on the mainstream adoption front.
Well, Robinhood just added Binance's BNB token.
Despite all the regulatory scrutiny around Binance.
Yeah, and BNB has a massive $150 billion market cap, listing it on a major U.S. retail platform like Robinhood. It signals perhaps growing acceptance or at least access for retail to these major ecosystem tokens.
Interesting developments across the board. Did the 1000X podcast guys offer any specific alpha or tips based on this?
They did, specifically around those prediction markets like Polymarket.
Okay.
Their advice was, counterintuitively, to bet no more often than yes. Essentially playing the odds that consensus is often wrong.
Fade the consensus. Classic.
Right. And crucially, they suggested using multilingual or local news sources to get an information edge, using prediction markets almost like an info arbitrage tool.
Smart. Any specific projects they like?
They praised Robinhood itself as a key long-term infrastructure play. And on the altcoin side, they mentioned liking things like Hyperliquid and Aerodrome, pointing to what they saw as solid fundamentals and good tokenomics.
Okay, so some specific names for people to research further. All right, let's try and synthesize all of this. For you, the listener, trying to make sense of this very messy market, what's the bottom line?
Well, we've really laid out two competing paths, haven't we?
Seems like it.
On one hand, you have this very specific, technically driven scenario. The BTC-Gold ratio reverses, macro data cooperates, and we get a potential surge towards $180K. That's the Crypto.Report view.
The optimistic, catalyst-driven path.
Right. Contrasted sharply with the historical warning, mainly from Cowan's analysis, saying, hold on, the clock is ticking based on Q4 cycle patterns. That view urges caution, watching Bitcoin dominance, being wary of a top.
History versus technicals and structure.
But the synthesis, I think, is that even for the bullish technical setup to play out, it relies on that structural absorption holding firm, the point the 1000X team emphasized.
So the institutional buying, the sideways bullish idea, that needs to remain true for the 180K scenario to even be possible.
Exactly. That structural strength is the bedrock. And interestingly, despite their different outlooks, all the sources essentially agreed on one thing. Discipline is key right now.
Positioning, managing emotion.
Absolutely paramount. Whether you lean cautious or bullish, making rash decisions based on FOMO or fear is likely the wrong move. The future of this cycle might genuinely depend less on repeating the old 4-year pattern.
And more on this new dynamic.
Yeah, more on whether institutional demand continues to absorb supply and whether this underlying infrastructure development keeps building quietly in the background.
Okay, so as a final thought for everyone listening, especially as you watch the CPI numbers tomorrow and wait for the Fed next week, here's something to chew on based on our sources.
All right.
If AI agents, like through Coinbase's new tool, are already starting to move crypto on-chain, machine to machine, does the old human psychology of the trading floor, the classic fear and greed cycles, still hold the same predictive power for where this cycle pops out?
Good question.
Or are we maybe shifting into a new era, a more automated, perhaps more structurally sound, less purely sentiment-driven phase of price discovery that could make historical cycle analysis, well, maybe less relevant than we think? Something to definitely mull over.